Today, in this video, I will explain about a trading method, which is called the Darvas Box theory, and it is used to trade in the stocks which have high momentum. Darvas Box system was introduced by Nicholas Darvas, who became highly popular through his book, which was so much liked by the traders. We will learn when and how the Darvas boxes are plotted, and during these which parameters should be overseen. But, before going ahead in the video, if you are new to our channel, then hit the like button, and subscribe our channel, so you cannot miss our upcoming videos. It is very easy to understand the Darvas Box trading system. This strategy is actually a techno-fundamental strategy. Thus, here we will consider both technical analysis and fundamental analysis also. In fundamental side, we will look for the PE ratio, future plan, debt reduction, financial reports and profits of the companies. From these points, we can select the companies which are doing well. After shortlisting them, our job is to analyze the stock of each company and find better trading opportunities. When the price is in the trend, then it keeps moving ahead by shifting from one range to other range. As you can see here, the price is in the long-term uptrend. But here, first the price moved in a short-term range. After some time, one point came where the price made a breakout to the current range, and then it moved further, and again shifted to the other range, which is above the earlier range. Thus, during this uptrend, we can find these boxes moving towards the upper side as the uptrend continues. In the same way, during the downtrend, the price moves in the range, and at one point, it breaks the current range, and moved ahead, and enter in the next range, which is below the earlier range. Here, we are talking about a swing trading strategy, so we will look our stock chart on daily time frame. This strategy is quite simple and interesting. Our first job is to find the stocks which are essentially stronger as per our requirements. After that, we will see each stock on daily chart, and try to plot the Darvas box. As the price breaks this box, we will make our trade entry. But the question is how to draw the Darvas box. Let me explain this thing in simple way. So, here are the conditions to plot the Darvas box. First, the price should be in the suitable uptrend. After that, we require the price, which makes new 52 weeks high. After marking new high, there should be 3 following days, which do not break the high. After satisfying these conditions, here we can plot the upper boundary of the Darvas box, and this upper boundary is called ceiling of the box. Now, just wait for the price to make its low. After achieving the low, the price should not break the low for 3 following days. This low is known as the lower boundary of the box, and this lower boundary is also called the floor of the box. Thus, our Darvas box is formed. Now the price moves ahead in the box, and we will require the candle, which makes the breakout to the upper boundary of the box for our buy entry. But, for highly appropriate breakout, this candle should have 2 properties. First, the candle which makes the breakout should have strong close. Therefore, the candle should have a small upper wick, so the high and close of the candle will be very nearer to each other. Second, the candle should make the breakout with high volume, for that we will take 25 volume moving average. The volume, at the breakout candle should be above 25 VMA. These things will increase the chances of our required breakout. Let us take an example to understand with more clarity. As you can see here, we have the chart of a stock on daily time frame. Initially, the price is in the uptrend. At this point, the price made a high. After making this high, what is the position of the next 3 following candles? The next 3 following candles did not break the high of this candle. So, here we will plot the upper boundary of the Darvas box. Now, further this candle generates the low, and the next 3 sequential candles do not break the low of this candle. So, here we will plot the lower boundary of the box. Thus, our Darvas box is ready. Now, wait for the candle, which closes above the box. Here at this point, this candle closes above the upper boundary. But, does this breakout candle have the required volume? Here, the volume at this breakout candle is above the 25 VMA. Moreover, this candle has smaller wick, which is nearer to its close. Accordingly, this candle with strong close and high volume indicates for the required effective breakout. After fulfillment of these conditions, we will make our buy entry at the high of this candle. If we follow the basic method, then our stop loss would be at the lower boundary of the box. But, in this scenario, the stop loss becomes big, and to make our trade successful, we will require higher target, which cannot be possible for most of the time. So, we should keep our stop loss at 40 to 60% of the box height. If the box height is very high, then our stop loss should be near to 40% of the box height. And if the height of the box is very small, then we can set the stop loss near the 60% of the box height. Remember, my friends, the setting of the stop loss requires higher risk management studies. For this instance, here the box is not very big in height, so we will keep our stop loss at the 60% of the box height, and for this particular situation, we will set our target at 1:2 risk to reward ratio. Risk to reward ratio should be changed according to the situations. For now, you can see, after our buy entry, the price moved effectively in the uptrend, and we successfully achieved our target. That was all. My dear viewers, honestly, a lot of hard work and time are required to make these types of interesting videos. In return, at least two small things you can do for us. Just hit the like button and make sure to subscribe our channel, so you cannot miss our upcoming videos. Take care of yourself.